Hawkins radiation rate. No, let's just look at this for a minute. Not only is it the shorts here, but this is again the black hole here for clearly what I just posted up a few on the Bunny Smasher here. Peacock, Life of Pi Peacock. Uh, find out. Well, we'll check that one out later too. Well, you go in there for the case. Are they over, under? That's why doing it kind of like this, you understand the subtones, and at least could factor the ranges. Now, S&P, NASDAQ, and Dow Jones, right on that clip.
Jim, let me begin with you, if I might, about the bond market. It looks like a very dangerous place to be. We keep saying the bond market, bonds are up today. Well, that's the yields that are up. The prices are going down.
World record speed
well, Happy New Year, and thanks for having me on your show, Tyler. Look, I think there's a couple of things going on. One is that what we have to understand is that policy and technicals have been a key driver of the markets in the fourth quarter and for a lot of last year. So last year what we saw was we had the Omicron variant that was rising. We had supply technicals, which were really, really positive for the bond market in that there was low net issuance. And also, we had corporate pensions, becoming fully funded and buying long-duration assets, and that kept long-end yields really low. As we start this year, we see a lot of that starting to unravel. The first thing that I can say is that a lot of the pension fund buying is probably starting to, leave the marketplace at this point as we move away from December 31st.
Well, all this building going on for the infrastructure bill. You'd expect Porter-John companies from Mike Rowe.
Surge. I know we're in the midst of it right now, but the
not doing what you want to do.
So I think that's a factor as well. And the other is that net supply, and I think this is probably one of the most important things,
is that
net supply of U.S. Treasuries in 2022 is going to be over 2.5 times the amount of Treasury supply, net Treasury supply in 2021. So the market's going to have a lot to digest going forward. All of the time when QE is coming to an end, which we expect by the end of March, and without a lot of that QE support, that's going to create a very interesting dynamic for yields.
Yeah,
I think at the start of this year, we're reflecting
that. You nailed it there for me. You've got all this supply coming on, so to
go through the poll of them if you just put them ones in the pews and you ask them, they get riled up because the preacher gets them going.
Is stepping away.
Correct. Yeah, that's one of the things that I think we're going to have to contend with
as
we go into 2022. We don't know what the Treasury market's going to really act like when the biggest buyer starts to step away. And ironically, this is going to come at a time when inflation is actually supposed to be declining. So it's not all bad news, right? So there could be some support for the Treasury market. But the bottom line, though, is with the Fed stepping away and GDP growth still expected to be good, that's going to probably, at the margin, push bond yields higher.
David, let's bring you in and get the stock market side of this equation. You say the easy money is leaving the market. That is.
Do you think that they'd love it when you put out the HUD, actually the level of the competitive market? They'd love to let that open up because they'll camp it. No, them on the other end pulling that trigger.
It has been. But one of the things you said in your note that stood out to me is this: corporate earnings are more overstated than at any time in the last decade, which means there is more risk in stocks than most investors see. Explain that to me. What do you mean?
Them both at the same time.
How do they get overstated or understated?
There's a lot of tricks in the accounting rule books, Tyler, and we've been studying them for years, and they're near all-time highs. And we saw the flip side of this during COVID when earnings were understated. They call it the kitchen sink effect. They write everything down, they clean their books off, so that when things look good again, as they have in the last year or so, the earnings growth, the earnings beats, the earnings comps look as good as possible so as to drive the stock up as much as possible. And so we've seen corporate America taking advantage of that trend, squeezing as many cookies out of the accounting cookie jar as they can.
See what that just looked like from my position.
To make earnings look as good as possible, to make the stocks look as good as possible. And that's
starting from this way, looking back down the road. You would say, in the zombie stocks there, do you really want the T numbers to go up at all? You want the federal government to go down. You want to have nothing if you like capitalism. You want them to not have any power in the bonds or companies that do it, that self-regulate it. You don't want them to say, well, as a private business, I didn't recruit the correct people from the how to do it efficiently, metrics, and work the system. And, well, that's a monster. 3B, 1B, the size of the monster, computer programming limits. If that's all you got, because you don't know how to do that, and doing a lot of the other stuff, unless ZBrush is made and you buy a Phantom computer.